Okay, we are going to do application 14.3, 14.4, and 14.5. That's going to be the adjustments for merchandise inventory, allowance for uncollectible accounts, and your adjustment for depreciation. And the first one is 14.3, and it is the adjustment for merchandise inventory. So the first thing you want to do is say, what was the balance of my merchandise inventory at the beginning of the period? So you go to line 5, merchandise inventory, and you see that the balance was 236,314.63. 236,314.63 at the beginning of the period. And then you do a physical count of the merchandise to determine if it's gone up or down. So you want to find out what the balance is at the end of the period. Merchandise inventory can increase or decrease. So you've got to ask yourself, what is the balance at the beginning and what is the balance at the end? The balance at the end of the period is 226,766.38. So our merchandise inventory actually went down this time. So we're going to take 236,314.63 and we're going to subtract 226,766.38. And that's going to give us an adjustment of $9,548.25. So we're going to credit this merchandise inventory. We're going to adjust it with a credit of 9548.25. That's going to reduce the merchandise inventory to make it accurately reflect the correct balance in merchandise inventory. So that's part of our adjustment. The debit side of this is going to be income summary, line 28. So you're going to put the same amount in income summary right there. Okay, so that's our adjustment for merchandise inventory. Our next adjustment is for uncollectible accounts, and that is stated as a percentage of total sales on account. So we have total sales on account of $248,500, and the textbook gives us that figure, 248,500. And they've determined that their estimated uncollectible accounts is going to be 0.8% of that total. So you multiply that times 0.008, and that's going to give you $1,988. And that is going to be a credit to allowance for uncollectible accounts, which is a contra account to accounts receivable. So we're going to put 1988 right there. And then we're going to go down, and the debit side of this adjustment is going to be on uncollectible accounts expense, 1988. So that's our adjustment for uncollectible accounts expense. And our last adjustment is for depreciation expense. We have depreciation expense for office equipment of $58.50 and store equipment for $52.50. So we're going to go do our office equipment. And when you record the depreciation expense, you don't record it in the asset, you record it in the accumulated depreciation for the asset. So the office equipment is going to be $58.50, and the corresponding debit for that is going to be depreciation expense office equipment. And then you're going to go back up, and the accumulated depreciation for store equipment, that adjustment is $52.50, and you're going to put that in depreciation expense for store equipment, $52.50. Okay, so those are the adjustments. I will say that there's also a problem on 14.5 about determining the book value of the depreciation and the book value of an asset. So let me go ahead and work that with you guys. It says the original cost of an asset is $10,540, and the salvage value is $2,500, and its useful life is 3 years. So the first thing you want to do is take the original cost, subtract the salvage value, and that is going to give you the total amount to depreciate. So $10,540 540 minus 2500 is 8040. And then we're going to use straight line depreciation. So we want to figure out how much per year. So in order to figure out how much per year, you take the total depreciation and divide it by the estimated useful life, which is 3, and that's 2680. So that's per year, 2680 per year. But this wants us to figure out what the value is of the equipment at the end of the second year. So the first year, you're going to say book value, which is not book value, original cost, less 1 year depreciation. So that is 10,540 minus 8,000, no, 2680, sorry. 2680 per year. And that is 10,540 minus 2680, 7860. So then the second year, we're going to say original cost less 2 years of depreciation. So that's 10,540 minus 2 years, so 2680 times 2, 5360. And that is 10,540 minus 5360. 5180 is what you should have for your book value at the end of year 2. The book value is the original cost less the total depreciation. So that is the first and second part of application 14.5.